Okay, welcome back to another episode of Banking Without Borders. Today we're going to dive into investing for beginners. And the truth is, it has never been easier to start because to be a successful investor, you don't really need to know that much. Kind of like being a great pilot. They don't necessarily know how to build planes or jet engines, but that doesn't stop them from flying planes. And investing kind of works the same. You don't have to be a financial genius or spend hours studying charts and company reports because there are products that we'll talk about in this episode like index funds and ETFs that make it possible to build wealth steadily over time without overcomplicating things. So in this episode, we'll explain what the stock market actually is and the main products you'll come across, and we'll cover brokerage accounts and which apps or platforms to consider, and we'll also dive into some strategies like dollar cost averaging and dividend investing. But first, Jan, could you please tell me what on earth is going on when I buy shares in a company?
Yeah, well, Johnny, thanks for the intro. Essentially, the stock market is a marketplace where people come to buy and sell ownership in companies. So when a company wants to raise money in order to grow or in order to expand, it can sell pieces of itself to investors. These pieces are called shares or stocks. And when you're buying a share, you're essentially becoming a part owner of that company. And if that company grows in value, your shares also become worth more. Some companies, they additionally share their profits through dividends, which are essentially cash payments that are distributed to shareholders. So if they earn a large profit this year, right, they would probably go ahead and say, you know what, we want to reinvest half of it, and the other half we distribute to our shareholders. And those dividends can either be taken as income, right? You can pay them out, buy your groceries with them, or you reinvest them to buy more shares, essentially. The idea here is you're not just trading numbers on a screen, but you're buying essentially into real businesses that make products, employ people, and also generate profits, and you share their success over time.
Okay, that's quite a sentimental approach to investing, isn't it, Jan? To think that you're not just a number on the screen, but you're really investing into a company. I quite like that. When I first started investing, the first company I ever bought was Shopify. I had an e-commerce company myself using the platform, and I felt like I really wanted to invest in that company because I thought it was really good. Do you think that sentimental approach is what people should have when it comes to investing? They should look for companies that they like the look of?
Yeah, it's probably not the best idea, to be honest.
To be sentimental?
Yeah, no, probably not. So I would not go ahead and purchase shares of companies that I feel attached to, or where I like the brand or whatever. I would probably go ahead and ask myself, how does that company make money? How does it stack up against competitors? But then also look at the financial track record, revenue growth, profitability, potentially even free cash flow, and then analyze whether the current price of that share of that company, current valuation, feels fair to me, right? And if it does, I would go ahead and purchase shares of that company. If it doesn't, I would go ahead and invest my money elsewhere.
And when it comes to investing your money, equities are one piece of the pie, or stocks and shares, but there are other market products such as ETFs, Jan.
Yeah, ETFs are essentially investment funds that hold a collection of different assets, often tracking an index like the S&P 500, the Dow Jones, or the DAX, the German stock index. And when you buy one share of an ETF, you're essentially buying dozens or sometimes even hundreds of companies at once, and you obviously gain a certain level of diversification, and that spreads your risk, and that's why ETFs are definitely recommended to beginners. I would even go so far and would say ETFs are probably the best investment vehicle on the stock market. Most investors they fail to outperform the general stock market by picking stocks, right? Many people overestimate themselves, even professional investors trying to pick just the right stocks that they feel will overperform, will outperform the market, and it just doesn't work statistically.
And in some cases, ETFs, they're not that expensive either, Jan. When you look at the overview of an ETF, you'll get like a sheet where you can see, where that ETF invests, its performance over time, how diversified it is, what the risk level is like. There'll also be something known as an expense ratio, and this will indicate how much it'll cost to use the ETF. And in some cases with Vanguard, that expense ratio could be as low as 0.0 0.03%. So if you were to invest $1,000 into that ETF, it would only cost you 3 cents. So the expense ratio is actually a really important thing to look at when selecting your ETF. There are a couple of other products, right, Jan, we could discuss. I mean, I feel like equity, so stocks and shares and ETFs are the fundamentals of investing, but there are also commodities like gold, oil, agricultural products as well that you could invest in. You know, just investing in a single commodity has a lot of risk. It's like investing in a single equity. It's not that diversified, and you can get ETFs that have commodities that will have a mixture of things like commodities and equities, and that will be more diversified. But of course, if you wanted to, you could invest solely in commodities. Commodities are typically a hedge against inflation. So during inflationary periods, people like to invest in commodities because they're a lot more secure. And as we've seen over the past couple of years, gold has really increased in value. And then there are bonds. Jan, could you explain a little bit more about bonds?
Bonds are essentially loans that you give to a company or sometimes even governments. They would go ahead and pay you an interest that's defined before issuing the bond. Bonds, in my opinion, they're a good alternative to easy access accounts, right? Because they often provide a higher level of interest. There's also some risk involved with them. Yeah, if the base rate changes, the value of these bonds on the secondary market can change as well. So if you wanted to go ahead and let's say you purchase a 6-month bond, right? You want to go ahead and sell it after the 3rd month. Then it could be that the value of that bond has changed, and instead of getting, let's say, 1,000 pounds back, we're only getting, I don't know, like 900 pounds back, depending on how much that level of interest has changed.
Yeah, I have roughly 50,000 invested in government-backed bonds at the moment, and I think the return is at the moment 3.73%. So it's not hugely significant. Brings in around £250 every month at the moment, although that did recently drop as a result of the Bank of England reducing the base rate. That is currently with a brokerage platform called Trading 212, who we've talked about before.
Yeah, in the last episode, I believe it was, or the episode before that, we looked at four trading apps that we found pretty good, and these are Revolut, which we think is very convenient for people that are already using Revolut for banking. It's super simple to use, but has a bit, some limitations on the investment options that are available within the app. Then there's Trading 212, which you just mentioned. It offers commission-free stock trading, commission-free ETF trading as well, I believe. Supports fractional shares, has automated pie portfolios, and is essentially available almost, maybe not almost everywhere, but in many different countries. So if you're living within the EU or the UK, you can be 100% sure it's available there. Trade Republic is more EU focused, available in 17 or 19 different markets within the EU currently. Primarily known for its ETF savings plans, also super low fees, and offers great long-term investing in general, especially for beginners. Also super approachable, great app. Great interface on the web app. And then there's Interactive Brokers, which I consider more of a pro product, to be honest. It's very complex interface, but offers access to almost every global market, and also excellent currency exchange rates, advanced analytic tools. So depending on what your profile is and what you're exactly looking for, one of these apps mentioned could be just right for you.
What about trading strategies, Jan? We've briefly talked, obviously, about the power of ETFs and the predictability in some degree with ETFs, because we know over time they have data that shows historical averages. What about actually going ahead and making purchases and buying equities? Are there strategies that we can implement to have the best possible outcome?
Yeah, there are many different strategies, Johnny, and if we would cover all of them, this episode would be very, very long. So I would say let's focus on 4 popular ones, some that we can also recommend. There's the dollar cost averaging strategy. That means you're investing essentially a fixed amount of money every month or at other regular intervals, regardless of whether the market is going up or down. And over time, what this does is it smooths out your purchase price, and helps you avoiding the trap of trying to time the market, buying when it's very cheap, or when you think you are identifying a certain trend, and that's something that even professionals get wrong typically. And this dollar cost averaging strategy, it's simple, it's disciplined, and works really well over time if you want to want to build some serious wealth.
Agreed. I did that process with, and I had quite a lot of success recently with Palantir, having started buying Palantir in 2020. Although the cost of Palantir has increased, so I don't have a dollar cost average where I think, okay, every month I'm going to buy, say, 5, 10, 50 shares. It's about how much money I can afford to spend. And so as the price has gone up, I'm only buying 1 or 2 shares. But over time, I still have, even though the share price is, I think, $171 today, I still have a dollar cost average, Jan, of, I think, roughly $25. So that's worked out extremely well for me. And I've just remained disciplined regardless of the market, because I look at Palantir as a long-term buy. I guess that's also a strategy, right? People just buy and hold.
Yeah, so a bit of a classical approach, in my opinion. What you do is essentially you pick one investment, you hold it over years or even decades and let it grow. And this avoids trading fees because you're just buying once, you're not buying in regular intervals, reduces stress, and also keeps you focused on these long-term gains rather than short-term swings.
The biggest thing with something like that is, people, if you're watching this and you're going to do buy and hold, is don't check your brokerage account every single day. You can't get into the habit of doing that. The stock market is so unpredictable and volatile that you'll see ups and downs, and in some cases you may go down 5-10%, but then within, like, if you're really into holding, within like 2 to 5 years, you could be up 100-200%. So you just have to be super patient, and you can't let your brokerage account impact your mood, how you're feeling. I think it was Jeff Bezos that said that to people who were invested in Amazon. Like, if we let our share price impact our mood, every time it goes up 10%, we're 10% happier. But then when it goes down 10%, you're going to be 10% sadder. You can't let that happen.
How often do you check yours, by the way, Johnny? Maybe
every
you
day.
mentioned that here. Every day? Okay, so not the best example.
No, I'm joking.
I check mine every 2 weeks.
Yeah,
okay,
yeah. Look,
I'm
joking. No, I'm joking. I've got a couple of brokerage accounts, so it would take too much time to go in between every single one. But I do check the stock market pretty much every single day. I have TradingView. There's a great website called TradingView.com. I have a premium account with that, and I basically just track. And I have my favorites, my watch list, which will have all of the different ETFs, so the equities that I'm invested in. So I am aware of what's happening from day to day. The total value of my portfolio, I don't know exactly, but yeah, I am keeping an eye on it pretty much every day, buddy. But I've got a lot of equities, so I am trying to keep an eye. I'm not day trading, but I'm trying to keep an eye on the performance of certain businesses. Particularly right now, I'm investing in companies that are heavily into artificial intelligence, companies that are building data centers, and things are changing every single day. So you do have to keep a bit of an eye on it. But even though I'm doing that, I'm not letting it impact how I'm feeling. Okay? I'm making sure that doesn't impact my mood. Just to go back to different investment strategies, dividend investing. This is when you buy companies that will pay dividends. And this can actually be a really good approach. It will probably require a large sum of money invested, which will take time unless you can do that initially, because you're getting paid per share, and if you don't hold a large amount of shares, you're not going to see a large amount of money in return in dividends. But there are some good places to look. There's a website called dividendmax.com, which will show you the best companies to invest in, which ones pay the most. Can you just explain core satellite investing to me, Jan?
Core satellite investing is probably a strategy that you're personally following, right? If I understood your experience correctly here. Essentially, what happens is that your core portfolio is made up of stable, diversified assets, for example, ETFs, or also certain quality stocks that you picked. And around that, you add satellite investments, smaller, more targeted bets on individual stocks or sectors like artificial intelligence that you personally believe in. Yeah, assures a steady return over time, right? Because most of your portfolio is diversified and stable. But it also lets you participate in these trendy topics a little bit, which might keep your motivation up over time.
Yeah, I didn't realize that I was doing a core satellite approach, or I just thought it was like being diversified, which essentially it is. That is the approach that I've taken, Jan. We haven't really spoken about your approach. What does your portfolio look like?
Yeah, I'm a buy and hold investor, I would say. As I mentioned, I barely log into my brokerage account because I don't care what these assets are worth right now. I don't need them to finance my lifestyle. Whenever I need them in a few years or even decades, they'll be worth more than they are right now. And that's why I'm just totally relaxed about it. I stopped trying to outperform the market long ago because I failed. right? As most people did. Tried to time the market, tried to pick certain stocks that I believed in. Just didn't work out. It worked out. It gave some return, but compared to the overall performance of, let's say, the S&P 500, I just underperformed, and that's why I said, that. I have to beep that out. I'm not gonna do that again. I'm gonna invest passively, diversified, and focused to build long-term wealth, and that's what I'm doing.
Cool. I guess that's probably a good common mistake to avoid then. Well, you probably said a few, but at least frequently looking at your brokerage account from day to day is definitely a common mistake to probably try to avoid. What other common mistakes do we have, Jan?
Overtrading would be one, which is essentially jumping in and out of the market based on certain short-term moves. And that often leads to losses and higher fees. Also being emotionally attached to the money that you invest, that's something that could cause this overtrading, right? If you really need the money and then the stock is going down and you know exactly that in a few months you want to purchase something and you need the money for that, that's maybe not a good scenario to put yourself in, and that could lead to overtrading.
If you're investing money that you fear that you might need later on, investing in equities is probably the worst place to put it. If I was a financial advisor, I would not advise people to invest their money if they think they might need it later on in the short term.
Absolutely not.
Possibly ETFs would be a better place, or bonds, for example.
Not even that, not even ETFs. Like bonds. Bonds would be the only place on the stock market I would put my money into if I need it in a few months or years. Okay. Like let's say 1 or 2 years, less than a decade. Let's say it like that. Other than that, easy access savings accounts or fixed term savings accounts if you know exactly when you need your money again.
What about fees and FX costs, Jan? Because when you make a play in the short term, you look at it, you buy your stock or you buy your ETF, you are immediately in the red as a result of fees.
Yeah, you're right. And even free platforms, they often charge a currency conversion fee, or they use an exchange rate that's not favorable. And over the years, these do add up. So be mindful that they exist.
If we are to wrap up today's episode, Jan, can we just end up with some really sort of key takeaways to help people just get started?
Number one takeaway, in my opinion, be consistent. So whatever you do, be patient and disciplined. And if you decide to invest long-term. Don't let the market influence your decisions. Just invest it and forget about it, because then it can grow and then you can build long-term wealth. That's the number one takeaway, in my opinion. If you have disposable income available to start investing, I think having a nice, broad, diversified portfolio with possibly some ETFs and some equities or some stocks and shares is the best approach. But really, buying equities, buying into a company, don't just buy in based on the news or Reddit or the next big hype train. Have a look under the hood. You don't need to get deep into it, but have a look. Does this company sell products that perhaps you think are going to be beneficial to society? Does this company have a positive balance sheet? Are they profitable? Just do a little bit of research. It shouldn't take too much time. And just consider using that disposable income that you have to dollar cost average. So just buy a small amount each month over time. And then as time goes by, if you start to earn more money, you have more disposable income, you can increase that dollar cost average in. Then there's the platform that you decide to use, right? It's just really important that you look at the platform you're going to be using and that it fits your needs. Is it something that you feel like comfortable using? I had a lot of difficulty with the interactive brokers, Jan. I know you didn't. You actually use interactive brokers, but instead I like to use Trading 212. I think maybe because my brain isn't as powerful as yours, I couldn't get my head around interactive brokers. But Trading 212 is a bit more simplified for someone like me. I found it quite easy, or at least I find it quite easy. Yeah, the reason why I use interactive brokers is the availability, right? I'm a resident of a country where not a lot of stockbrokers are available in, so having access to one is already a good thing. And interactive brokers is just the most available trading platform there is, from my knowledge.
And interactive brokers, I mean, if you're someone that's going to be purchasing a lot of stocks and shares in US dollars, perhaps you're buying American equities and you're not from the States, so you're going to have to make a currency exchange, then interactive brokers can be very good because they have fantastic FX rates, practically the mid-market. I don't want to get into the weeds here, but they're just a really good brokerage for fees. If you're watching this now and you're already buying shares, you're already doing some of the stuff we're talking about today, and you're not using some of the brokerage apps that we talked about, so Revolut, Trade Republic, Trading 212, interactive brokers, then please do share the apps, platforms that you're using. I'd love to hear from you and find out about the platforms that you're using. Maybe Jan and I can try them out ourselves, or anyone reading the comments, watching this video, listening to this episode. So let us know if you have any questions. Subscribe to the channel if you enjoyed the video.
Yeah, if you don't subscribe, these strategies won't work. So that's the first step in order to build wealth long term. Please subscribe, and thanks everyone for listening. It's been a pleasure as always.